So this video is to explain how income protection works. Income protection is a policy that's, again, can be advised on alongside life insurance and critical illness. It's similar but different to critical illness. Income protection is designed to either enhance or replace sick pay. So it will pay out for all the same sort of conditions that the critical illness will, but it pays out on a monthly basis rather than on a lump sum. It will also pay out for shorter term illnesses that critical illness doesn't cover, so things like stress or back pain, anything that your doctor would sign you off work for, income protection will pay out. Now, the way it works, it kind of differs between employed and self-employed clients. So if you've got a client that's employed, they will have some sort of sick pay. The income protection policy is designed to sit alongside the employer's sick pay. So if you have say a best case scenario, somebody that works for the NHS, they're on 6 months full pay and 6 months half pay if they're off sick, your income protection policy wouldn't actually pay them anything at all until they'd received their full 12 months sick pay benefit from their employer. The assumption is that if they're not in a position to go back to work after the 12 months, income protection would then start to pay from month 13, and it would pay them a monthly payment either until they were able to go back to work, or if it's a long-term illness, it'll actually continue to pay until retirement age. If the person decides that they maybe want to go back to work on a part-time basis, say it was stress was the reason for being off work, and they want to go back part-time, the income protection will continue to pay a proportional benefit to top up the income that they've lost by going part-time. Equally, if they decide to take a kind of completely different career, again, stress is a good example. If they were in a particularly stressful occupation, they're able to go back to work, but they decide to go back in maybe an administrative role that's less stressful. Again, the income protection policy will continue to pay, and it will top up what they've lost in earnings. So it's a really good level of cover. It's designed to increase in line with the retail price index as well. So if somebody is claiming on a long-term basis, every year the benefit they receive will increase in line with the retail price index, just to make sure that it remains relative to the cost of sort of buying stuff in the shops. And for an employee, you can basically tailor the policy to suit what sick pay they get from their work. So maybe they only get 1 month sick pay. What you would do is set up a policy that would start to pay them from month 2. Or if they had some savings and they maybe only get 1 month sick pay, but they could cover themselves for 3 or 4 or 5 months, you would just get the policy to start paying out from the point where their savings were running out. And the idea is that it saves somebody having to go back to work too early, or just give them time to recover properly. If the client's self-employed, it's slightly different, because self-employed people don't get sick pay at all. So it works on exactly the same basis. You basically would start the policy paying out from whenever the client felt that they would need the policy to kick in. Typically it's going to be after less time. So you would maybe look at a policy that would pay out after they'd been signed off work for maybe 1 month or 3 months. But again, it will continue to pay until they return to work or until they hit retirement age. The difference with self-employed clients is, because income protection is to protect your income, it's underwritten based on what your income is at the point of claim. So the one issue that you have with self-employed clients is obviously income can fluctuate, but there are some policies that will guarantee the income as well. The other nice thing that it does is, if the client's had a claim, they've returned to work, and then a year later they're signed off work again, as long as they've kept paying the premiums on the policy, it will continue to it will start to pay again, even if it's for a recurrence of the same condition. So it's actually a really, really good level of cover to have. Potentially better than critical illness, although it doesn't pay the lump sum. It covers more conditions, and you know, for a longer term as well. You also have the option with it of adding in redundancy cover. And this is a kind of slightly different, it's a shorter term policy. So if the client's made redundant, it'll pay them an amount relative to their income for up to 12 months after they were made redundant. And again, it's just to give them a little bit of a cushion to get back into employment, but not have to kind of rush into things. But it pays the bills in the meantime. So that's what all these policies are all about, is just financial security and paying the bills. And the beauty with them all is the cover is very, very flexible. So you can tailor the price, you can tailor the level of cover to suit what the client wants to pay. Because at the end of the day, it's, you know, you want to have the best level of cover, but it's got to be affordable for the client. So if they give you a budget, you can tailor a policy to suit the budget they want to pay and the types of cover that they want to have. So it's very, very flexible in that respect.